미국 중앙은행 페드가 지난해부터 금리를 계속 올려서 5% 넘게 올리면서 치솟았던 미국의 인플레이션이 꺾어지고 있습니다. 그러나 노동시장과 서비스업 등이 강하게 버티면서 경제는 여전히 괜찮습니다. 그리고 다음 주 페드는 시장이 마지막이라고 기대하는 금리 인상을 단행할 것입니다. 월가에서는 높은 주식의 밸류에이션 외에는 시장이 별로 두려워할 게 없다, 이런 얘기도 나오는데요. 여름 랠리가 계속해서 이어질까요? BCA 리서치의 덕 페타 주식 전략가를 모셔서 시장 상황과 예측에 대해서 들어보겠습니다. So let's start with the first questions. Do you think the stock market is in a bull market or is it a long bear market rally?
I'm not so sure that the distinction matters, but as I understand it, there are some who say who count a bull market or a bear market as a 20% peak to trough move.
Mm-hmm.
So by that definition, we're already in a bull market because we are 25 or 26% above the 3,571 low from last October. However, we have not yet passed the high of around 4,800 from January of 2022. And some people define bull market more strictly and say you have to pass the previous peak to really have a bull market. And by that definition, we're not yet in a bull market.
Mm-hmm.
To get to that definition, to exceed 4,800 when we're already at 4,500,
mm-hmm.
the S&P 500 needs to rise another 300 points. 300 over 4,500 is about 6 2/3%.
Right.
If you forced me to guess, will the S&P 500 rise another 6 2/3% before it recedes? Yeah, I think it's more likely than not that it can go another 6 or 7%, and therefore that we are in a bull market. I'm not sure that matters all that much because I do expect that the S&P 500 will not rally beyond the summer. Okay, so using September 21st as the definition of the equinox, that would mean the stock market in the United States can rally for another 2 months. But I do think that when the rally is over, we are going to see a meaningful decline. That we are going to see
this year, you mean?
Well, beginning in the second half of this year, beginning sometime in the second half of this year, I think a decline that ultimately goes into the double digits, that is at least 10%, will ensue. And therefore, I think that an investor tactically ought to still be bullish in the very near term, expecting that the S&P 500 is going to rise even more. But an investor with a 12-month outlook ought to expect that 12 months from now, the S&P 500 is going to be below where it is now.
And that means you don't believe this market solved every issues, not cleared, right?
Right. Look, I believe that a recession is inevitable in the United States. Now, we have argued in my team at BCA Research within the U.S. investment strategy team that the first half of 2023 was going to be really good for equities. And the second half was going to be more problematic because we thought the nearly unanimous consensus view that a recession would have begun by now, that a recession was sure to begin by the middle of 2023 was incorrect. And we thought it was incorrect because we thought that consensus view underestimated the strength of the United States consumer, given the mountain of excess pandemic savings that households in the aggregate accumulated. And that those excess savings, coupled with a strong labor market, would provide American households with the resources to continue to consume at a rate that would stave off the start of a recession until sometime in 2024. Now, our best guess is that a recession is going to begin sometime in the first half of 2024. And that's why when we look out 12 months, we think equities are going to be lower than they are now. And we do expect that the S&P 500 will peak sometime in the near future, sometime, once we get into late September, early October, we think you will have seen the peak in the S&P 500.
That means you believe the recession will come in 12 months, but you also said expect the stock market will go up to maybe all-time high over the 4,800.
Sure.
Is it logical?
Well, let me explain my logic, and you can decide if it's logical. Again, going back to sort of looking at this as the full calendar year for 2023 and where we were coming into the year, and when you and I last spoke in September, in New York, that we thought equities, the path of least resistance for equities in the United States in the first half of this year was going to be up because we thought expectations were dismal and that they were way too negative. We think that equities are going to peak soon because, in our view, what's going on right now, what we expect will ensue over the rest of the summer, is the expectations bar is going to be lifted. And when we started the year with investors expecting real GDP growth in the United States would be somewhere between 0% and 0.5%, that made it that really all the U.S. economy had to do was be able to walk and chew gum at the same time, and it was going to be able to exceed those incredibly bleak expectations. Now, we never expected a robust economy in 2023. We thought the U.S. economy could grow at 1.25% to 1.5% real. That's adjusted for inflation. So the difference between our 1.25%, 1.5% expectation and the market's 0 to 0.5% expectation was really big. Now what we think is occurring is the consensus is raising its expectations. And we expect that before the summer is out, those expectations are going to exceed ours. And that then in economic terms, and most importantly for stocks, in terms of S&P 500 earnings per share, that markets are going to be set up for disappointment. And once that bar is reset at too high of a level, then the S&P 500 is going to peak, and we expect will enter, again, a meaningful decline, whether that decline begins at 4,600, 4,800, 5,000. If it begins today at 4,500, we think you're going to see the S&P 500 down, well, from 4,500, at least 450 points, and it may well test the 3,600 lows. So we think it is worthwhile for an investor to, when he or she looks out into that, into the period when that recession is going to begin, when expectations are going to begin to disappoint, I do think it's prudent to look out and say, okay, if I believe that logic, then I am going to have investment strategy in place to get more defensive, to protect the assets that I manage against that looming decline. So that's, I guess we've always looked at, before we got into 2023, we've always looked at the near term, and we continue to look at it this way, as really a story of two time frames. That there's a different expectation for 0 to 3 months for us than there is for 12 months out. And so that's the logic. We still think 0 to 3 months is favorable, but we think 12 months is not favorable for equities. And it's all about that resetting of expectations, that now that it's going to be much more difficult to exceed that bar, we think the path of least resistance for the S&P 500 will turn out to be down, and that's in contrast to what we've experienced in the first half of this year.
And that means it's not a good time to buy the big tech stock right now, right?
Here I'll engage with the question, but I'm not a bottom-up analyst. And when I covered the financials, so I really don't have any experience in tech. But broadly, when we've talked before, when people are talking before, it's either thinking Apple, they're thinking Tesla, they're thinking Nvidia. Apple is already enormous. It's a fantastic company, But the bigger you get, the harder it becomes to outperform. The more difficult it becomes to outgrow the overall economy or the overall stock market. So I think that's just, I have no idea when people are going to cease wanting to buy Apple's products. But I do know, looking from 30,000 feet, that it becomes more and more difficult to be able to outgrow everyone else's past expectations. For Tesla, incredibly successful. It created a category, right? We didn't talk about electric vehicles before Tesla existed. However, now every single incumbent car maker in the world has really ramped up its electric car design and production. If nothing else, you would think that that's going to bring down the prices of electric vehicles. So I think that's certainly a headwind for Tesla in the future. Now, it's up to any portfolio manager's skilled tech analysts to look at the expectations for Tesla and try to determine whether or not they're too high or too low. If they're too high, I think the stock's going to have a lot of trouble. If they're too low, the stock can continue to gain. For NVIDIA, it does certainly appear to be priced pretty aggressively, so that, man, people really, there's going to have to be a whole lot of ongoing demand for its chips that are apparently more suited for artificial intelligence applications than other competitors' chips. So, to buy NVIDIA now, I think you're wagering that those expectations aren't high enough. And if you want to sell it now, you're wagering that those expectations are too high. Again, no expertise in this space, but if you ask me to guess, I would think those expectations are awfully high.
Okay. But I think the environment of big tech, around the big tech is, I think, are favorable, because big techs continue to lead the market, and expectation for the AI boom are still in place, and interest rate has been falling recently. So, and their valuation always too high for the market analyst. How about you?
Well, sure. Look, certainly tech has got momentum behind it. And in the short term, that is absolutely something that an investor dismisses at his or her peril. You have to heed, you have to heed the momentum. As far as the interest rate argument, I think I'm alone in the entire investment management space on this one, but I think it is tremendously overrated, the link between interest rates and tech stocks. They're just, when you look at the empirical history, there is not any consistent correlation whatsoever. And in fact, interest rates have been rising this year, but tech's done really, really well. And it is the tech type companies that are in the consumer discretionary sector and in the telecommunications sector that has powered discretionaries and telecoms to basically the same performance as tech, dramatically outperforming the rest of the stock market, dramatically outperforming all the rest of the other sectors. So when I think about tech, I really like to set aside any consideration of interest rates, because I think that is a myth, and it's a very powerful myth, and it is won a whole lot of adherence in equity markets, but I think it's a myth. One other thing that you didn't mention to consider with tech going forward is, are there going to be regulatory headwinds for the big tech companies? It seems to me that there certainly will. The European Union has really come after Google and Facebook and tried to make things more difficult for Amazon. And in a very fractious United States political environment, it seems about the only thing that Republicans and Democrats can agree on is that big tech needs to be reined in. So I would expect that going forward, these large tech companies are going to face regulatory headwinds, and maybe they're something that changes the long-run growth profile for the industry, at least in the intermediate term, at least in, let's say, 3 to 5 years. So I do think, while no doubt tech stocks have a momentum tailwind, no doubt they have been extremely skilled at growing earnings at a rate that outpaces the overall rest of the stock market, but they are potentially facing a less friendly regulatory environment. And I would advise everyone to re-examine the purported link between interest rates and tech stocks' relative performance.
Okay, I got it. And assuming that the bull market is maintained, which sector or stocks will have the next leadership after the tech? Which stocks are you looking at?
From my perspective, more cyclically exposed sectors will outperform as the rally continues, and more defensive sectors will underperform. So the cyclicals I'd be looking at would be energies, industrials, and materials. They do well when the economy is doing well, but most importantly for stock performance, they do well when the economy does better than it is expected to do. The reverse holds true for the defensives. So I would be shunning consumer staples, utilities, and healthcare, at least from a relative performance perspective. So I would expect the more cyclically exposed sectors to continue to do well as the rally continues. Once it peaks, perhaps it will be time to take on some more defensive exposures within equities, as well as reducing equity exposure for a multi-asset manager, just a run-of-the-mill asset allocator.
Financials is one of cyclicals. And do you, how about, you're thinking about financial, I want to hear. You said you were the finance analyst, you are?
Yes, well, it was a little while ago, but I do look. The issue that has been on everyone's mind from a macroeconomic perspective this year, as it relates to the stock market and the financials, has been what was termed the banking crisis that began when Silicon Valley Bank folded. That was on a Friday. Then on the next Sunday, Signature Bank in New York was seized. And then finally, about 2 months later, at the beginning of May, First Republic Bank failed. It was bought by JP Morgan. The remains of First Republic Bank, after it had been seized by regulators in the United States, was purchased by JP Morgan. We always argued that banking crisis was an exaggeration. We would term it instead as banking turmoil. Now, we don't know how it's going to turn out, but I do think this is something very important to watch for the U.S. economy and for U.S. financial markets as well, is does the banking turmoil make U.S. banks as a whole less willing to lend? And therefore, does that mean that there is less credit availability in the United States economy for households and businesses? And does that in itself drag on growth? Does it weigh on growth? Does it pull it down versus what we otherwise would have expected to see? To this point, 4 months after Silicon Valley Bank failed, there isn't any evidence that the banks have gone into sort of a defensive crouch. Okay? We have seen loans held on bank balance sheets actually increase very slightly from where they were on Wednesday, March 8th. Silicon Valley Bank failed on Friday, March 10th, and the Fed gives us comprehensive data about what banks own every Friday through the previous Wednesday. So we get the data for Wednesdays. Additionally, bank deposits, while they are down since Wednesday, March 8th, all of the decline occurred in the 2 weeks between March 9th and March 22nd. So we're right where we were as of March 22nd. Additionally, the loan to deposit ratio in the banking system in the United States is right about 70%. And that is only 20 or 30 basis points higher than it was before Silicon Valley Bank failed. So, as a former banks analyst, I can tell you, you look at the loan to deposit ratio for an individual bank to try to determine if that bank is overextended and if it is particularly susceptible to a run, or if its profits are going to decline as it has to seek out new higher yielding deposits to keep, to be able to support that fairly sizable lending portfolio. When you get concerned is when the loan to deposit ratio is in the 90s. For the entire US banking system, it's in the 70s. For the largest 20, or it's right around 70. For the largest 24 banks, it's in the low 60s. There are about 4,600 to 4,700 banks in the United States. The other 4,600 that loan-to-deposit ratio is in the mid-70s, still pretty low, but it's incredibly low. It's suppressed for the 24 largest banks in this country, and that suggests to me that banks have ample capacity to continue to lend, and that therefore, I don't expect, it is my base case that we are not going to see a meaningful contraction in lending, that we are not going to see banks circle the wagons or go into that defensive crouch, be hiding under the desk, not taking incoming phone calls. Provided that that's the case, that's good. That would suggest that the U.S. economy has dodged a bullet from those bank failures. Now, it's all ongoing, right? So we are watching every Friday at 4:15 New York time when the H8 report comes out from the Fed. We're watching every Thursday at 4:15 when the H41 report comes out that details how much the banks are borrowing at the discount window and how much they're borrowing from the new Bank Term Funding Program, the BTFP, which the Fed put in place after Silicon Valley and Signature Bank's failures, which, to my mind, greatly mitigated the risk that we could have a banking crisis, because via the BTFP, every single bank can borrow at face value against the holdings of its treasury and agency mortgage-backed securities. For the agencies, think of Fannie Mae, Freddie Mac, Ginnie Mae. Now, those securities may only be worth 90 cents on the dollar. That's what I assume they're broadly worth. As interest rates have risen, the value of those securities has declined. So if you had some withdrawals from your deposit base and you had to sell something that on your balance sheet was carried at $1, but only brings back 90 cents, that's problematic. That can make a run become a self-fulfilling prophecy. Silicon Valley Bank had more than 60% of its assets in securities. So it was incredibly vulnerable to a run. Now, every single bank in America can take those withdrawals. For every dollar withdrawal, they can get $1 for their treasury and agency holdings and repay those withdrawals. And we know, if it's still true that U.S. treasuries are the risk-free asset, we know that those securities will all be worth 100 cents on the dollar at maturity. So what the BTFP does is it allows banks to bridge this difficult period when they had to contend with this really sharp and sudden rise in interest rates. So anyway, the bottom line is no banking crisis. It was never a banking crisis. It was always banking turmoil. And what we heard from 3 of the 4 largest banks in the United States on Friday when they reported second quarter earnings, JP Morgan, Citibank, and Wells Fargo, that across the board beat expectations, is that the banks are not necessarily under any particular duress. Now, we will hear more from the regional banks as this week goes on, and they were always at more risk than those 4 SIFIs, the 4 largest banks. But the bottom line from my perspective is we do not have anything approaching a banking crisis in the United States.
Okay. I would like to ask about the liquidities. M2 continues to decline. The Fed continues to do the QT, and Treasury is issuing a lot of bills and bonds after the debt ceiling issue is resolved. Still, the market continues to rise. Has the correlations between the liquidity and the market disappeared?
That's a great question. This is the sort of thing we talk about all the time at BCA's economists. I think there are 2 impacts. One that has been incredibly benign for financial markets is reducing MT, continuing the quantitative tightening, issuing more bills to suck more cash out of the system. That all has exerted downward pressure on inflation. And indeed, perhaps a lot of the rally in the last couple of months has not just been about growth expectations rising and there being and ongoing surprises, positive surprise in growth, but we've been getting positive surprises in which inflation is clearly decelerating. And I would submit that it has been coming down in the last couple of months, more than has been expected. And when we look ahead, it looks like that more rapid rate of deceleration is set to continue across the second half of the year. So that's been a real boon for equities. Now, it is acting to slow growth, but growth has not slowed as much as expected. So that's also a win that, gee, this has really helped to get us towards more of that Goldilocks outcome in the United States, where, according to the fairy tale, the porridge is neither too hot nor too cold, that indeed it has been just right. And I think the outcome that we've been seeing across this year has been very close to just right for equity investors. Now, I expect that the disinflation is very much going to continue. That is a strongly held view within BCA, and I completely agree with it. Growth has slowed less than expected to this point, and with the labor market still appearing to be extremely robust, I would expect that we're going to see growth decelerating pretty gently. I think it'll culminate in a recession, but until the recession actually begins in the first half of 2024, per my best guess, I think we're going to see a pretty gentle decline. So again, that's sort of in line with Goldilocks. So I don't think those relationships are broken. I think money supply growth still has something to tell us. And I think liquidity within financial markets has a lot to tell us. BCA was founded on that basis. BCA stands for Bank Credit Analyst, and was our founder's insight in 1949 that he might be able to anticipate the future movement of financial markets if he watched money flows throughout the banking system. So that stuff is very important to us, but we think what we've seen in the first act of this play is that it's been really, really good for financial markets. It's been good for the economy. It's meant that the Fed has not had to act to throttle the economy, to really pull on the reins really hard or slam on the brake really hard and stop it immediately. It's what we've seen with inflation slowing is that the Fed has been able to permit the economy to slow kind of gradually. And if we really are on the trajectory that I'm suggesting, then one more hike next week of 25 basis points, in our view, ought to do it. That should be the end of the rate hiking cycle in the United States. And I think that is something that financial markets will greet as welcome news, to the extent that they haven't already concluded that there's only going to be one more hike, and that's already perhaps reflected in asset prices.
Right. And you said you predict the recession will gonna begin in next year, first half. And what's the main reason you believe like that? Because sticky inflation and further tightening from the Fed, or the lagging effect of the tightening, or what is the main reasons?
For me, the main reason is the last one you mentioned, lagged effects of the tightening. I think we're all familiar with Milton Friedman's phrase that monetary policy works with, quote, long and variable lags. There's a whole lot of tightening in the pipeline now that the Fed has already hiked the Fed funds rate by 5 full percentage points, or 500 basis points. We expect that there are another 25 basis points coming. So we believe that monetary policy settings are already restrictive. They are already at a level that will slow economic growth in the United States. We already see fairly slow economic growth. Just it's been a whole lot stronger than expected this year, because it has taken longer for these rate hikes to really have an observable effect on the United States economy than I believe the consensus expected. And I think now that we look back on it, that those lags may have been longer this time, because the Fed's tightening cycle was preceded by unprecedented fiscal transfers from the federal government to United States households. That is what built up this massive excess savings cushion for American households, and has allowed them to keep spending over the last 7 quarters at close to 2.5% after adjusting for inflation. It's a 2.4% annualized rate over 7 quarters after adjusting for pretty high inflation. So that's the story for me, is those savings are eventually going to run out. That giant cushion is being reduced.
Please.
And right? As we see aggregate demand slow, we think that means the labor market is going to weaken, which means that household incomes are also going to cool off. In real terms, household disposable income has risen in 10 of the last 11 months. We expect that it also rose in June, so it's going to be 11 out of 12 months. As that ceases, then you're going to have more pressure on the consumer. That's going to make the economy slow more. That's going to feed into less hiring, to layoffs. That's going to drive incomes down even more. And ultimately, you have this negative self-reinforcing cycle where slowing begets slowing via the labor market. That's where I think we're going. I think it's inevitable. I think it's simply taken longer to show up this time because households and the broader economy had a lot of buffers around them before the Fed embarked on its tightening cycle.
Okay. And even if a recession hits, wouldn't it be okay for the stock market if it's not so serious?
It certainly might be. And our base case is that this will not be a severe recession, that it will either be average or somewhat milder than average. So when I think about that in investment strategy terms, I think that means the S&P 500 may not have to test 3,600 lows. Mm-hmm. However, I do think earnings per share for the S&P 500 will decline by at least 10%. And when I say that, I'm not saying year over year in any quarter. Just imagine taking a 4-quarter moving average of forward expectations. You could also do it with trailing earnings, but I prefer markets forward looking. Mm-hmm. I think we will see the expected forward 4-quarter earnings decline at least 10% from their peak. On average in recessions, they decline between 20 and 25%. It's closer to 25%, so let's call it 25%. So just a 10% decline or just a 10 to 15% decline, which I would think is realistic for a particularly mild recession, that's a lot to ask multiples to expand to keep the S&P 500 from declining, especially when we've got a forward multiple in the 20s right now. So, right, if let's say we have that forward 4-quarter earnings per share decline by 15%, that means if equities remain unchanged, it means multiple has to go from 20 to 23. 20 is high. 23 is really, really high. Right. If we were to have a 20% decline in those forward 4-quarter earnings, then you need the multiple to go from 20 to 24. I don't think that's going to happen. I don't think you have to see multiples collapse if it's a mild recession, but I think you could see, even if they just stay the same, you can see the S&P 500 decline by as much as those forward 4-quarter earnings expectations decline from their peak. If the multiple would come off 5 or 10%, go from 20 to 19 or 18, which are still high levels relative to history, then you've got a better than 20% decline.
Okay. Recently, the 2-year yield rose above 5% and 10-year yield rose above 4%, but it fell a lot then. How do you think the bond yield will move?
Well, our fixed income strategists see the 10-year treasury yield as range bound, unless, and range bound, let's say from 3.5% to say 3.85%. Okay, that's the number they've been using as the top end. They don't see us getting above 385 in any sustainable way unless inflation breaks out. Mm-hmm. Okay, and remember that our expectation is that inflation is going to decelerate across the rest of 2023. We could be wrong, of course, but that's our view, and we feel pretty good about that ceiling for rates. Now, maybe it's as high as 4%, but I completely agree with the logic that unless inflation really surprises to the upside, we've got a cap on how high that 10-year treasury yield can go. On the downside, we think until the labor market starts to show clear signs of cracking, that 3.5% is the bottom. Now, it's our expectations, that team's expectation, and I share it, that we're more likely to break it on the downside, but I think that's going to take until 2024. I think we're going to have to see those net payrolls increases the first Friday of every month go from being 200-something to 100-something, then just double digits, then turn to zero and even have a minus sign in front of them. And it looks like, at least for the next couple of months, we're not going anywhere near that minus sign. And all it takes to keep the unemployment rate at a steady state in the United States is somewhere between 80 and 90,000 net new payrolls in a month. So we're still going to see more people being put to work. We're still going to see downward pressure on the unemployment rate in the very near term. But once that changes, and we think it certainly will, that's when you see the 10-year yield get below 3.5. As for the 2-year yield, if we are correct that there's one more hike coming next Wednesday on the 26th at the end of the FOMC's meeting, and that's going to be it, then that places a ceiling on the 2-year yield, which is the maturity that is most sensitive to expectations about Fed policy. So we've got a ceiling there. Now, we expect the Fed there aren't rate cuts coming anytime soon because the economy is still too strong for it. And inflation is still, if it's in the threes for core inflation, it makes it hard for the Fed to cut rates. So we expect that we are going to see this 5.25%, 5.5% for a very long time. So that should put a bit of a floor underneath the 2-year yield. So if only one more hike and they pause, it's capped on the upside. But we also think if the Fed remains on a very long pause, then it's pretty well that bottom of the range is also pretty secure. So the bottom line is we do not see U.S. Treasury yields moving all that much. We believe they are going to be range bound both at the 10-year maturity and also at the 2-year maturity.
Okay. How do you think the dollar will move?
So currencies are notoriously difficult to forecast.
I understand.
Here's what I'll say, that when I look at it in the simplest terms, I think of the dollar as a counter-cyclical currency. So if global growth is going to surprise to the upside, then the dollar is going to decline. And if global growth surprises to the downside, then the dollar will rise as safe haven flows head to the United States. Given that in the near term, it looks like the global economy is in the process of perhaps surprising higher for the rest of the summer, then I think we can continue to see downward pressure on the dollar. But once we have the recession begin in the United States, and if that leads to a recession globally, then I think you'll see the dollar appreciate. So for me, it's very much a global growth story, and that as long as global growth is good, the dollar will continue to lag. But once things turn around as recessions are imminent, I expect the dollar will outperform other currencies, because when I look at the entire menu of the world's major currencies, I think that only the Swiss franc and the yen are more defensive than the US dollar.
Thank you very much. That was my last question, and thanks for the great answers, and it's so insightful. And I would like to invite you again soon.
Well, I'd love to come back, and thank you very much for a really enjoyable half-hour discussion.
Yeah, thank you. Thanks for being with us again. Thank you.